Hello. Thank you for joining us from wherever you are, and welcome. I'm Dr. Danielle Labotka, and I'm a behavioral scientist here at Morningstar. Today, I will be moderating the webinar, Navigate Custom Model Portfolios with Morningstar Analysts. And today, joining me are our titular analysts, the ever-impressive Jason Kephart, who is the Senior Principal for Multi-Asset Strategy Research, and Stephen Margaria, who is a Multi-Asset and Alternative Strategy Analyst. They just wrote a fabulous report on navigating the custom model portfolio landscape, and they also wrote another report, which will be the 2025 U.S. Model Portfolio Landscape, which will be launching in June. Gentlemen, thank you so much for joining me.
Happy to be here.
All right, so let's get into it. Now, if you're anything like me, you spend a lot of time thinking about cake. And in my travels through the world of cake, I found this trend where people will go to a grocery store or to a bakery, and they'll find a completely made and decorated cake. They'll take it home, and then they'll wipe off all the frosting and put on their own decorations. Now, at first, this might seem a little odd. After all, you just paid for a pre-made cake, and you're undoing some of that work. But on second glance, you say, well, on the other hand, they do now have a customized cake, and they didn't have to do all the work themselves. A similar trend is underway in the financial planning industry with custom model portfolios. Did you know that our Voice of the Advisor study found that 73% of advisors use model portfolios? So what's stopping the other 27% from getting in on this game? The most common answer people gave was that they have a preference for being able to personalize the portfolios they give to their clients. So today, we will be asking the question, do custom model portfolios allow advisors to have their cake and eat it too? So to find out, I'd first like us to take a step back and lay some groundwork for our audience. And I'm going to go to you first, Jason, and just ask you a pretty simple question, at least I hope it is, which is, what is a model portfolio?
Yeah, so model portfolio is something advisors can use to kind of scale their portfolio management across their client base. I would even take a step back from kind of going to the grocery store to buying the cake. It's almost like kind of finding a Julia Child recipe for a cake, and what the recipe is going to tell you is the asset class mix, stocks, bonds, maybe alternatives, how much to put in each, and the ingredient list is going to be the underlying funds the asset manager recommends an investor or an advisor use to kind of implement that recipe.
All right, so we're baking cakes, we got a great recipe, but I'm guessing that there's more to it when it comes to custom model portfolios, which is what we're talking about today. And custom model does sound a little bit like an oxymoron. So Steve, I was wondering if you could tell us, what does that mean and how do they work?
Sure, and you're absolutely right. This can be a gray area. Anything for this research, we denoted anything outside of a model provider's off-the-shelf offerings as being custom. Mm-hmm. And we found that financial advisors are working with model providers to tailor portfolios more to their clients' needs and preferences. And continuing on with the baking metaphor here, instead of advisors just receiving the recipe, it's like they're working with their own personal chef. So, a lot of providers are using their off-the-shelf models as a starting point for customization. And, custom by definition, can mean a lot of things. But we found some common themes across model providers in terms of, how they're helping advisors customize portfolios. So some of the biggest things were fund substitutions. So say, swapping out actively managed funds for passively managed funds, tweaking the asset allocation, so like the stock bond split, moving that up or down, or adding additional asset classes. The trading frequency, so maybe you want to rebalance semi-annually instead of quarterly. And then finally, maybe consolidating the fund lineup. Maybe a client wants a simpler portfolio.
So it sounds like there's a lot of different ways that advisors can really customize a portfolio, which potentially could be a bit messy. And I think we'll get into that a little bit more later. But first, I also wanted to talk about the fact that you all call this an inaugural report. So this is the first time that you have done a custom model portfolio review. And Jason, I was wondering, why now?
Yeah, and so we've been doing research into model portfolios since like 2020 is when I think we first started launching analyst ratings on them. Mm-hmm. And we've been kind of keeping an eye on the universe, watching it grow, watching it evolve. One of those evolutions we keep hearing more and more about from asset managers and financial advisors is this kind of middle ground between the do-it-yourself investors who want to build their own portfolios and the ones who just want to use the off-the-shelf version of a model. And that middle ground is really where custom lives. Mm-hmm. And we're seeing more and more firms and financial advisors, I think, kind of meet in that middle, because ultimately what I think an advisor wants to do is have their own kind of flair. Maybe when I'm making a recipe, I'm always going to put more garlic in it. That's kind of that's a guarantee.
Hopefully not in a cake.
Maybe. I don't know. We'll see. But essentially, I think, that's where we're seeing a lot more of these interactions happen for a couple of reasons I think we'll talk about. But generally, we just keep hearing more and more about it. And once we start hearing it from a lot of different angles, that's when we're like, well, okay, we need to really put some pen to paper and kind of help share these insights with others.
Okay, so there's definitely an appetite that we're seeing here. And Steve, can you tell us which are the firms that are really dominating this space right now?
Sure. So we surveyed a number of model providers to see, what their assets look like in the custom space, and those that do custom and that responded to our survey. We found that BlackRock and Wilshire were the two largest players in the space right now, at least out of the ones that we surveyed. Acknowledging that this isn't exhaustive, there could be others that we weren't able to capture. But Wilshire at over $50 billion, they leverage relationships with at least one large broker dealer to boost their custom business. And then BlackRock, they're the largest model provider out there. Mm-hmm. So it wasn't a surprise to us to see that their custom assets were so high. So the last time that we surveyed assets for last year's landscape report was in mid-2023, and since then, this group we found has grown their custom assets almost 50%, which that's a significant growth, and we expect that growth to continue as the space gets more competitive. More model providers enter, and as they expand their services as well.
Right, so it's definitely growing. I think we can feel safe in saying that. And Jason, why do you think that so many asset managers have been drawn to providing custom model portfolios?
Yeah, and I would just add to Steve's comment, I think of the asset managers that you don't see on that list, that you might recognize from the model space, all of them, I think this is a top-of-mind initiative that they are working on. And I think when we do this survey again, a year, 2-3 years from now, I think you might see some more names show up on there. But I think for an asset manager, it's kind of like an evolution of how they distribute their strategies and intellectual property. Right? Their portfolio construction and how they build portfolios and manage them is kind of like their IP. And I think that is something that resonates more with financial advisors when they're having conversations than, hey, buy this fund that's hot right now, or buy this fund that's hot right now. And then, you disappear for 6 months, the hot fund's no longer hot, you come back with a new hot one. Yeah. That's kind of an exhaustive situation for a financial advisor, but I think that is kind of the way it was in the past. But now I think by coming in and talking about it from a portfolio context, you're talking about a lot of different products. It could be open or closed architecture. We're seeing much more of a trend towards open architecture, which means model providers aren't using only their own in-house cooking to kind of decorate the plate. But essentially, I think for asset managers, it's a great way to kind of just engage financial advisors. Mm.
Yeah, it sounds like also we're trying to really engage this metaphor too.
It's almost lunchtime in Chicago.
And you know what's on our mind. Well, before we go on to our next question, I would like to note that we have an audience poll that I think is particularly relevant for all of the financial advisors out in our audience, which is, what is your preferred approach when it comes to handling portfolios? Is it a matter of outsourcing it and taking a model portfolio right off the shelf? Do you like to customize a model portfolio like we're talking about today? Or is the preference really for doing it all yourself? So while that is going on, we have a relevant question here, which is why I ask it for you all. But in the report, and you've already alluded to this a bit, is that you talk about there being a spectrum of approaches that advisors can take, from completely outsourced to completely DIY with those custom models sitting somewhere in between. So, how can an advisor determine which approach is right for them? Jason, do you have some insights into that?
Yeah, and I think, the advisors we see most likely to adopt model portfolios are probably those who are more focused on kind of like financial planning, estate planning, income tax management, retirement planning, and maybe their value add to the client isn't just, I'm going to have some kind of benchmark beating return. So they want to put all their emphasis on the portfolio management side. So they're willing to outsource that to kind of that third party, whether it's a BlackRock, Wilshire, American funds. And then the do-it-yourself advisors, I think, like the rep as a PM is what they're kind of commonly called too. I think for them, the value add really is that portfolio management. I think that they're the ones who don't want to give it up as much. But I think what we've seen is that models help really kind of streamline performance across a client base. So say you have, 10 moderately risk-averse investors who all have some kind of a 60-40. We've heard anecdotally is like as a rep, as a PM program, those 10 clients might have very different experiences. So the portfolios might be kind of dissimilar. But what the model portfolio does is kind of standardize that offering so you can kind of really monitor it in a much more holistic way, I think. But then the custom comes in where, okay, I do want to outsource most of this, but my clients have certain preferences and wants that I really need to make sure these portfolios are fulfilling, because ultimately the goal of portfolio is to keep an investor invested, and that's how they're really going to reach their goals.
Yeah, I know that we hear that from advisors all the time, that personalization is becoming more and more something that they have to worry about for their clients, and that being a holistic planner is something that people are worrying more and more about. So I can see why those model portfolios or being able to customize model portfolios are really becoming such a popular option for financial advisors. But, I think it's always important to provide a very balanced look of things. And so, Steve, I was wondering if you could talk to us a little bit about the pros, but also, the cons of using a custom model portfolio.
Yeah, so starting with the pros, so really emphasizing the fact that custom models are this middle ground between outsourcing and building it yourself. If with custom models, you can still benefit from some of the simplicity and the scale that model portfolios can provide. And for advisors, also having a say in some of the investment decisions. But as we know, there is no one-size-fits-all portfolio for clients. So, having the ability to better tailor it to clients' needs, preferences, or even the advisor's preferences, could lead to better outcomes for the end client. Then final pro is just, you still get to tap into the investment expertise of the model provider that you're working with. Some advisors may not have that in-house, so they can still benefit from that. Now, with the pros also come some cons to this.
Right, show me the seedy underbelly of custom model portfolios.
Yes. So, likely model providers aren't going to be doing this for free. So, there's going to be there's likely to be an additional fee tacked on to that, and that's really important because, as we know, fees come directly out of investor returns. So, it's important to keep that in mind here as well. Also, there might be a minimum number of assets needed to access this service, or like a minimum account balance. So, smaller account balances or smaller advisor practices, might not be able to benefit from this type of service. And then finally, even though if you're going the custom route, it's not as time consuming as building it yourself, it is more time consuming than outsourcing. So, just something for advisors to keep in mind there.
Right. So it kind of sounds like it's maybe, it provides a lot of benefits, but it's not necessarily going to be the right route for every practice or every client. You have to kind of evaluate it based on how the pros and the cons weigh with each other.
And one thing that I think to consider is the less time you're spending on portfolio management, that's more time an advisor has to spend with their clients. They have time to work on managing their business because a lot of RIAs are small business owners. There's a lot of work that comes with that too. And also lets them, do more time like reaching new clients. So, free time is kind of an invaluable tool that I think the model portfolios in general, whether they're customized or not, really do give financial advisors.
Yeah, that's a great point. I know that Michael Kitces does research on how advisors use their time. And to your point, a lot of them are kind of pulled in a lot of different directions because many are operating small businesses. So it is good to keep in mind that is a way that it can be beneficial to advisors too. Well, I'm sure many of you indicated that you have some preference of being able to help by either doing a model entirely yourself or customizing it. And talking about that really reminds me of something in behavioral science called the IKEA effect, which basically means that we have a tendency to place a little bit more value on things that we helped make. I know that I myself experienced the IKEA effect even when just putting together IKEA furniture. A couple weeks ago, I went to IKEA to purchase a table, and I had read the reviews beforehand, and everybody said it was the most difficult piece of IKEA furniture they have ever put together. And so I'm not going to lie, it was really hard, but when I finished, I do feel like I valued the table more as a result of it. In fact, it might be, in my estimation, the most valuable table in my house, even if it's not actually the most valuable one. But I think that that's an important point for advisors to keep in mind too. Like, we might have that tendency to think that I've provided more value because I helped in some way. But when it comes to the portfolios that you're giving your your clients, you really need to make sure that there is actual value being added to it too. And so this kind of all makes me think, customizing portfolios seems pretty complicated, right? You're taking something that's ready-made and you're turning it into something with basically endless iterations. So Jason, can you tell us what you think are some good things advisors who are looking to customize model portfolios should know?
Yeah, and I think it's important to keep in mind the end goal, which is to help the clients reach their end goal. So you don't want to take a portfolio that's kind of like designed for their risk tolerance and make changes that might change its risk and return profile. I think that's like one of the biggest things we're kind of worried about when we think about custom is, do you go so far custom that you're kind of on you might as well have just built it on your own. So I think you want to keep in mind that, like, if you are going the custom route, starting from an established framework, it does save you time, but if you're going to ditch the framework, then it kind of, counteracts itself.
Right. You could have just gotten the model portfolio or not at that point. Okay, great. So I want to give a plug to our audience for a moment, which is that a reminder that we are going to be having a Q&A after we finish our conversation here. And so if you have questions that you would like Jason and Stephen to answer, please enter them, and you can keep entering them. We have a few more things to discuss first so that you can hear what I'm sure will be brilliant insights from them on your question. Now, in the report, you walk through some case studies to help people kind of understand how changing things within a model portfolio can kind of have different downstream effects. And so I think it would be good for us to walk through some of those examples to help illustrate for our audience what this really looks like. And here's where we have our second audience poll, which I think is relevant for both the advisors and asset managers who are in our audience today, which is, how much of a portfolio are you comfortable allocating to crypto? And the reason why we're asking this of our audience is because in your report, you guys talk about crypto and a crypto creep. And I think it's an interesting asset to consider because all of the parties involved, the advisors, the asset managers, the clients themselves, they're all going to have their own opinions on how much crypto belongs in a portfolio. So I would really like to hear you kind of walk through this example. And Stephen, I was wondering if you could take the reins on it.
Yeah, sure. And this is it's a hot topic, of course, and something we would imagine asset managers and advisors are getting a lot of questions about from their clients, like, how much should we allocate? Should we allocate it all? And maybe even what is it? And so I think it makes a good example for custom models because it shows how the risk profile can change. If you add a volatile asset class like or asset like crypto. So in our kind of made up scenario here, say a client hits it big in crypto, and they go to their advisor and want their advisor to allocate 10% of their traditional 60% stocks, 40% bonds portfolio to crypto, funding from the stock sleeve. So the advisor goes ahead and allocates 10% to crypto, 5% to Bitcoin, and 5% to Ether, since those cryptocurrencies can now be accessed through ETFs, so they can have it right in their account with their other funds. And so those two cryptocurrencies have seen incredible gains over their lifespan, but that's come with a lot of volatility in between. So to put that into perspective, the baseline 60/40 portfolio has been pretty steady, over the last 5 years. But Bitcoin and Ether, they average anywhere between 6 and 8 times more volatility than the baseline 60/40, which is significant.
Yeah.
And so, you really have to pay attention to, its contribution to the portfolio's overall risk. So kind of, sticking with our example of adding 10% to a portfolio, that 10% allocation, based on our research, would contribute almost 40% to the portfolio's total risk, which again, that is a lot. And we've discovered that 5% is really the tipping point, where if you go beyond that, that's when the risk profile of the portfolio really starts to change. And so, and looking at the portfolio's overall volatility, 5% and beyond is where you really start to go past where, the 60/40s, volatility would be. Now, if you had invested in crypto in your 60/40 over its lifespan and over the last 5 years, you would have outperformed that baseline 60/40 portfolio on both an absolute and risk-adjusted basis. But we make some key assumptions in our research. First being that you're rebalancing monthly, so theoretically you would be buying low and selling high. And then most importantly, that you would be holding on to your crypto. And that's really hard to do during extreme drawdowns like we saw at the end of 2021 through 2022. So, final point I'll make is that, overall, we've seen, Bitcoin and Ether become, more correlated with equities. So, that kind of diversification factor that you're getting might not be there, as it was in its early days. So, overall, I think it's a good example of, how customization can lead to, change in the portfolio's overall risk profile.
Yeah, and what you're talking about, it really reminds me that advisors are kind of juggling the fact that now, trendy assets can be kind of directly marketed to their clients in a way that didn't really exist before. And so advisors are kind of in this position where they have to figure out, where does my client's interest in an alternative asset class fit compared to their goals and their risk tolerance and their timeline? So we actually recently did some research on what people understand about private markets and how interested they are in private markets. And one of the things that we found is that it's very likely that people's interest in private markets is outstriding their knowledge of these different opportunities to invest in them. So whether it's private equity, we see that kind of more broadly people understand, but even still, it's just kind of at 50%. But when you get down to specific products that people might be investing in, like BDCs or semi-liquid interval funds, you really are running into this issue where people don't know what they want to invest in. They might want to invest, but they don't really know what it means. And so that private-public convergence is kind of providing an additional layer of difficulty for advisors.
Yeah, and I think you're going to see a lot more on the public-private convergence, particularly how it relates to like portfolio construction, how to use it in a portfolio, coming from Morningstar research throughout the rest of 2025 and beyond, because we do know it's like kind of a hot topic now, this democratization of privates. It reminds me of a story I recently heard too, of a mutual fund, an ETF, and an interval fund walk into a bar for lunch. Lunch is important. And the bartender recently had inherited some bonds from his grandmother, who's giving while living. Grandma's okay, but he doesn't know what the bonds are worth. So he goes to the mutual fund and asks, do you know what this bond is worth? And the mutual fund, their mutual fund's old, he's 1940 Act, scratches his head, thinks, can I get back to you at like 6 p.m.? He goes, okay, I'll come back to you. He goes to the ETF. Can you tell me what this bond is worth? The ETF says, oh yeah, $103.91. He goes, oh, that's a good price, but trust but verify. I want a second opinion here. So next he goes to the interval fund. The interval fund takes the bond, looks at it very carefully, reads the fine print, slowly folds it up, puts it in his pocket, and says, well, what price do you want it to be? Which I think highlights one of the challenges we're thinking about is like the valuation techniques a lot of these interval funds and private investments can have. And is the valuation really realistic of what the asset class is really performing? The risk has been called volatility laundering. That's something I think you'll also see a lot more about us from in the future.
Right. That's really great because, as we start to think about how these things get incorporated into clients' portfolios, we want to ensure that we're understanding how it fits into what client wants and what they don't want. But I wanted to stick with the idea of alts a little bit because I think it is a really interesting opportunity advisors have to kind of incorporate them more because of custom model portfolios. And Jason, I know that you've done some work on liquid alts, and I was wondering if you could talk a little bit about what it looks like in the custom model landscape.
Yeah, and so liquid alts is something we actually know pretty well. I first joined Morningstar in 2014 as an analyst on the alternatives team. So we've been covering liquid alts for about over a decade now. They really got popular after the 2008 financial crisis as a way to diversify. I think a lot of advisors and their clients today might be thinking and looking at kind of the news headlines and, wow, there's a lot of uncertainty in the market. The U.S. equity market had a correction earlier this month that since could come back a little bit, but still a lot of uncertainty. And the best way to protect against uncertainty is through diversification. And so liquid alts are potentially one way you can add diversification to a portfolio, but there's a lot of things to consider. So right now on screen, we're showing the Morningstar style box for alternatives. This is a tool that kind of lets you see kind of what are the diversification benefits you kind of expect from a liquid alt strategy. What it does is kind of decompose equity beta. And the reason we focus on equity beta for this is stocks are generally going to be the riskiest thing in your portfolio. So if you're going to diversify, the first thing you should think about is, well, let's diversify away the risk. But as you can see on the chart, the categories, the liquid alt categories, aren't all created equally. There's a wide mix of them. Long short equity, for example, on the upper right hand of the box. Those are net long strategies, but they can short. But generally, they don't really have a lot of diversification benefits from a correlation standpoint. They're going to tend to move in line with the stock market up and down. You're almost hoping that if the market goes up 10, your long short equity manager is going to get you 6. And if the market goes down 10, your long short equity manager is only going to lose you 4. And that's how you're going to kind of win over the long run. So it could be a good way to reduce volatility without giving up as much returns as you would with something like cash or adding more bonds. But then we look kind of on the bottom of the style box. What you see is systematic trend. That's been one of the best kind of pure diversifiers, I would say, from a portfolio standpoint. And what these funds do is they kind of trend follow. So they can go long or short, many, many different asset classes, but stocks, bonds, globally across the world, currencies, commodities. So in 2022, that was actually the best performing liquid alternative strategy. And so that's one that I think if you're really worried about stock bond correlations breaking again, which I'm on team, I'm not that worried about that given where bonds are right now, but I know a lot of people are. The 60-40, I don't think it's dead, but some people do. But I think that's one area that I would look to if I really wanted some like long-term insurance. But what we've seen too in that asset class is the number of trend-following funds has really ebbed and flowed over time, and investor interest has kind of ebbed and flowed too, because basically they did great in 2008, great in 2022, and in between there was a whole lot of getting whipsawed and kind of low returns and maybe some losses that people ultimately weren't able to stick with. So I think like the key thing is when you're thinking about liquid alternatives and customizing a model portfolio by adding them, you really need to make sure what's your goal first. I want to add diversification to the portfolio, or am I trying to enhance returns, which maybe that's what private credit or private equity is probably better used for than a diversifier. But generally, you want to make sure what you're trying to achieve, and then can this fund actually achieve it? And so these are the kind of things like you really need to think about before you add liquid alts to a portfolio. And even though some can help, not every portfolio needs liquid alts.
Right. So again, it's thinking, okay, what am I trying to achieve here? How does it fit into my clients' goals and their wants and needs and comforts? And then really thinking about, okay, does this belong here or not? Not just throwing it in because it sounds fun today. Well, I mean, that does remind me that we have just kind of covered alts at this point in time. And I think we would like to do something that's maybe a little bit more traditional, like a nice, calm bond. So let's talk about the bonds. I know you have an example in the paper, and what does it look like to kind of shift bonds around? I think you could probably tag team this, but does somebody want to start?
Sure. Yeah, I can start. So yeah, in our made up scenario here, maybe an advisor is using one of Vanguard's off-the-shelf models. So it's comprised of all passively managed funds, and maybe they're looking for more income from the portfolio. Maybe they have a client that's in this model, and that's maybe in retirement, so they're more focused on current income. And so they take a look at the bond portfolio, and they swap out some of the passively managed funds for actively managed funds, and just generally funds that are higher yielding. Now, we can see the result in the customized portfolio, looking at the 12-month yield, is that the income did increase, but the composition of the bond portfolio significantly changed. So, starting with credit quality. So, the baseline model was invested in all funds that invested in or tracked investment grade bond indexes. So and they added in funds that can venture into non-investment grade bonds. So that would be below BBB rated. So that's going to have an impact on the risk profile of the portfolio, and that increasing the risk of the bond portfolio may not be what you're looking for from the bond portfolio. Traditionally, people want it to be that kind of ballast to the equity sleeve. And then looking at sectors, the corporate bond allocation more than doubled. So that's going to increase the credit risk, and that it could make the portfolio more sensitive to the economic cycle.
I think what we've kind of seen year to date kind of proves out this kind of point of if you're chasing yield, that doesn't always lead to better outcomes. We've seen a very choppy equity market year to date, but year to date investment grade bonds are outperforming high yield bonds, which came into the year very tight credit spreads. And when there's tight credit spreads, that doesn't necessarily mean there's like more default risk by any means, but there's certainly more price risk when things get a little uncertain, like we've seen recently. So I think it's important to be very careful and not stretch for yield just for the sake of income. Not only does income not the most tax efficient way to kind of get withdrawals from your portfolio because it's taxed as ordinary income. You could be better off focusing on total returns and selling off long-term capital gains. That way you kind of get a reduced tax bill. So there are a couple other those are considerations I would think about. And I think it's also important, just because two things look really great on their own doesn't mean they work really well together. I mean, think about chocolate ice cream on a hot summer day at the ballpark.
Sounds good.
Fantastic.
Yeah.
Hot dog, hot summer day at the ballpark.
Also sounds good.
The Cubs are probably losing, unfortunately.
Or the Sox. They're certainly losing.
There's not a lot of winning going on in Chicago outside of the custom model space. But you wouldn't want to put the chocolate and the hot dog together into one kind of bowl, right? So you're going to want to kind of keep things separate, even though they are good. They might not mix well together. So I think that's kind of one of the things I would keep most in mind when I'm doing any kind of fund substitution. Like, how does it really impact the portfolio, even if, hey, it's a fixed income fund for a fixed income fund? There's a wide range of fixed income funds out there.
Right. So what I'm gathering from this, it really is kind of a balancing act when it comes to these customizing model portfolios, because you might have a certain purpose in mind, and that's great. We've already discussed you should certainly do that. But when you make different swaps, you have to be careful of the downstream effects that they can have on a portfolio and how it would actually fit with your client's needs. So before we turn to our Q&A, I'll just ask you both, do you think that custom model portfolios allow advisors to have their cake and eat it too? Steve, why don't you tell me first?
Sure. Yeah, I think so. And I think just really playing into it being a middle ground between outsourcing and building it yourself. That it really does allow advisors to tap into the simplicity and the scale of model portfolios, while also being able to tailor the portfolios closer to their clients' needs and preferences. And I think any time that you can really hone in on the client's objectives, that should lead to better outcomes for the end investor.
That makes sense to me. How about you, Jason? What do you think?
No, I agree. I think it's a great entry point, particularly for the DIY advisors who don't want to give up all the control on the portfolio side, but want to have more consistent performance experience across their client base.
Okay, great. So let's turn to the audience, and I see we have a question here. It's, what do you think are the primary reason investors want to or should customize their portfolios? They have some suggestions here, like taxes, values, company stock, conviction in different asset classes, or something else. Do either of you want to lead the charge in taking a stab at this?
I think all of the above. I think on the taxes side, where we've seen the most personalization is kind of through direct indexing, which could be part of any model portfolio. It kind of would replace maybe your large cap equity exposure, for example, in the U.S. That's going to get you much more customization on the tax side that can really have some real tax offsetting benefits in the long run. At the overall portfolio level, there's probably a little less tax loss harvesting just because you have fewer moving parts, and hopefully most of the parts of your portfolio are going up, whereas individual stocks you get a lot more variation. But I think in terms of values, it goes back to making sure people really believe in their portfolio, because that's going to help them stay invested. I'd be a little more cautious at a really strong asset class view. You do want to, that's kind of something you'd probably want to outsource, but if you're going to sin a little. So tilt a little bit into that asset class, maybe not a whole bunch like we saw with the crypto example.
Right. Do you have something to add?
Yeah, no, I agree. And I think, I would just add that, I think, we do, that this is a, service, and, I think we're going to see a lot of, additional like value adds, like tax management and that type of thing tacked on to, custom models. So it's not just tweaking the portfolio, but it's going to be those additional things that, could benefit the end client and kind of, even, and, fit in more with like what a client, wants, their values.
Right. Right. So like you said, you got to have some buy-in from your clients. You want them to feel like it reflects what they want, what they need. And if it does, then they're more likely to stick with it. We also have somebody wondering whether Morningstar tools can help with modeling a portfolio.
Yeah, so all the examples in the paper, we kind of use Morningstar Direct to kind of build, and the portfolio construction tools on there. So I do think there are a lot of tools that are available to advisors through that. Also the Morningstar Style Box for Alternatives, Morningstar tool that I think really useful for kind of evaluating a liquid alternative fund is kind of a first step.
Okay, good. Yeah, I mean, like you said, you're using it yourself, so. All right, and somebody wants to know what trends you're seeing around the use of option-based funds in model portfolios. They also ask buffer funds to manage risk or covered calls to diversify income. Steve, do you want to give it a shot, or?
I mean, I think, just generally, we are going to see more of these be introduced, more of those types of more sophisticated strategies be introduced into models. There are a number of providers that are kind of wading in here, and I think we will see this expand. But yeah, maybe Jason can talk more about the particulars.
Yeah, what trends have you noticed or not noticed?
We haven't seen any
noticed.
I haven't seen any buffer ETFs in models yet, and I'm a little skeptical about the buffer ETFs. Anytime something sounds too good to be true, I think it's a little challenging. Also, I think there's a lot of investor education need around buffer ETFs in particular. The covered call type strategies like your JEPIs of the world, I think we are seeing more of them. There definitely is a demand for income in model portfolios, much like we see in mutual funds and ETFs. But I think the buffer ETFs, I think we haven't seen that yet, and I do think you'd have to do a lot of investor education to kind of make that really work.
Okay, so the moral of the story is nothing yet on the horizon in terms of capturing interest there.
Not on the buffer side. On the covered call side, I think definitely.
Yes, on the buffer. All right, so now we have a question that's about, the firms that we've talked about. So someone's curious about how Wilshire and BlackRock managed to capture such a large market share, and what do you think is going to be the companies that emerge as, the third, fourth, fifth largest providers?
I think, as I mentioned with Wilshire, they leverage relationships with, kind of large broker dealers to help that, and BlackRock, their name in the industry, and kind of just like their overall size, and I think also. The iShares, brand, being able to create, model portfolios of iShares ETFs has been helpful there. And I think, in terms of, kind of the next, we do see kind of Russell and Invesco in those, third and fourth places right now. Invesco saw the largest growth, since mid-2023 out of the providers that we surveyed. But there are some kind of like smaller or larger asset managers that have, that are, smaller players in the custom space right now, like, T. Rowe Price, American Funds, JP Morgan. I think we would expect to see them, expand their services and expand their custom assets here. Not sure I can definitively say that they'll be top five, but I think we would expect their assets to grow.
Okay, so you're not making any bets about what 1, 2, 3, 4, and 5 are going to be in the next 10 years, but you have some guesses about why certain firms might come up in the rankings. Yeah. Do you have anything to add to that?
I would say don't forget about Vanguard.
Yeah. That's a good one not to forget about. Somebody else is asking, as an advisor, how can I manage these conversations with clients? For example, if I have a client that really wants to invest in crypto, any insights here?
Yeah, I think it's all about keeping things in context and, making sure that if something's a part of a portfolio, it doesn't become overwhelmingly part of the portfolio, which is what I think we try to do with our research and looking at like where's the tipping point where it really does change the risk and return profile. Alternatively, I think there's not enough that you said about having like a fun bucket in your portfolio that lets you kind of live out your animal spirits in things like crypto or maybe other kind of single stocks that you really have a strong feeling about, or an asset class you have a lot of conviction in. Having that kind of fun bucket kind of slightly separate from the portfolios that are designed to get you to your goals, that could be a good way to kind of balance between, I want to make sure the client has its cake and eats it too.
Right. Yeah, I mean, it does remind me of something that we often talk about, which is, the fun sleeve, which allows people to do it. But also, if you're having a conversation with your client, just to step in on the behavioral science side, what I would say is it's always good to bring it back to goals. We talked about that you need to find a purpose in any adjustments that you're making here, right? And so ensuring that it fits those client goals, but also that your client understands what's going on. Your clients probably aren't professionals in the financial advising industry, and so they might need help connecting the dots, especially when it comes to those downstream effects that you guys talked about in terms of volatility or in terms of the kind of risk that they're exposing themselves to. So I think it's all about ensuring they know what they want and how you're helping them get there. Steve, did you have anything to add on it?
Yeah, no, I mean, I think that's exactly right, and I think just maybe showing the the impacts to the client, just so they understand, like you were saying, that here's your objectives, and here's what might happen to the portfolio. It could be really helpful to frame that to the client.
Yeah, great, thanks. Somebody wants to know, how are providers measuring their model portfolio assets? How do they decide what's going on here?
It's tricky. It's definitely, that's part of the why it's such a gray area right now too, is it's really hard to really nail down a specific number. Even for the off-the-shelf model portfolios, it's not always clear exactly how much money's falling off of big platforms like Envestnet or maybe the wirehouses or the big broker dealers. I think we ask for their best guess, their best honest guess, and that's what I hope we get. Right now, Canada is out of scope, but we do have some, some awesome colleagues in Canada who I think are starting to look at model portfolios there too. So, in future editions, we might have more to say on the Canadian model marketplace.
That's good to know. So it's expanding in terms of our input too. All right. So how do custom model portfolios perform compared to a model portfolio? I think that's a really interesting question. Is it not, basically the person's asking, is it better not to touch a model portfolio when looking only at returns?
I think it depends. I think if you're doing a lot of fund swaps and maybe saying, well, this BlackRock model has all these iShares ETFs, but my clients, they don't see Vanguard or Fidelity in there, or Schwab. They're not going to like it. So we're swapping in, some passive for passive, but just different brand names. You're going to get very, very similar performance. If you're swapping in a core bond ETF for a core plus active manager that's adding on a lot of credit risk, like we kind of highlighted before, that might give you pretty different performance, particularly in drawdowns. But I think in general, it's it really depends how custom do you make it and what are the customization differences.
Yeah.
Yeah, I would just echo. It depends on the extent of the customizations, and I think one thing that we heard from providers is that they can help with kind of that benchmarking too. So they have something that's more comparable. Relative to the kind of off-the-shelf model.
So they might have some recommended swaps for people. Is that what I'm hearing? That the providers themselves might have an idea of if you want to switch this in, this might be a good option.
I mean, I would imagine that they would, but they'd also want to make sure that they're kind of working with the advisor and the client to kind of meet those preferences. Okay. But I mean, I'd be surprised if they weren't kind of giving their opinions on the funds.
They have some thoughts. Yeah. Okay, so someone says, for someone new to creating portfolios, where can we learn how to create your own effective custom model portfolios?
I think Morningstar.com is a great resource. Not to toot our own horn.
I've never heard of it.
Yeah, I've seen you on there before.
Yes.
But I think our colleagues like Christine Benz and Amy Arnott on our portfolio team do a lot of really good kind of introductory type articles into building portfolios. Christine Benz's bucket approach is really interesting, and those are a lot of portfolios you kind of start with. You can also look at kind of how target date funds are allocating as kind of a starting point. Target date funds, right, are designed to take you from age 25 when you're very young all the way through retirement. So if you want to kind of find out what a typical portfolio for someone your age or your client's age might look like, maybe look at a Vanguard or Fidelity target date fund, the index ones, because they're very easy to see the asset class mix. And that might give you a good starting point to kind of start with.
Great. And someone wants to know, how do slight shifts in strategic asset allocation, like 5%, 10% adjustment, impact risk and return outcomes? Do you want to tackle it?
Sure. Yeah. So say you're moving the allocation to stocks up 5 or 10%. I think you would probably expect that the portfolio would be more volatile then. And obviously if you move it the other way, it may be less volatile. And over long periods of time, we would expect equities to outperform bonds. So the expected return might be higher, but it might come with more volatility along the way.
Makes sense. So which areas of allocation tend to yield the most meaningful improvements?
I think that's going to depend too on where your starting point is, where you're starting with and where you're trying to improve or customize. I think a lot of things are probably, a lot of the customization we see are probably like do no harm type things. Like if you're doing active for passive, it's not going to change the overall portfolio complexion much. If you're adding in values, that's probably not going to change the proposition too much. So I think a lot of the customization we see is do no harm. I think one of the more interesting things we've seen is some more tactical managers, who kind of have a really wide range of portfolio allocations they can do. Maybe the advisor really likes what they're doing, but they're a little too crazy for them in their kind of like standard approach. So
they're not ready for the ride.
They're not ready for the full ride. So what they'll do is kind of say, okay, well, here's the strategic asset allocation. Here's the tracking error I can stomach and my clients can stomach. Do what you do within there. Let them cook, but within these certain boundaries. Because I think sometimes when it's like a benchmark-free type strategy or an unconstrained strategy, you can get really different looking portfolios that could either work really well or not well, and those big swings can be, I think, harder for clients to stomach. So I think that middle ground of setting like an SAA and a tracking error budget, that's kind of a way I think to kind of really interestingly like take advantage of value, things like value tilts or growth tilts, whatever you have, without really giving all of it up.
Okay. So someone's asking a question again about the different firms, and other people are catching up to BlackRock and Wilshire. What innovation or unique capabilities do you see emerging from other players in the market, if you've seen any at this point?
I mean, I think it goes back to the value add beyond just helping them customize the portfolios. So it's the tax management, or kind of maybe there's maybe they're introducing something like direct indexing. They could further help with that tax management, and maybe kind of as I was talking about before, that like additional benchmarking help, and those types of things I think would be kind of where we would expect it to see it going. Kind of this more full service, this kind of almost like a one-stop shop for advisors, really leaning into kind of what Jason was talking about at the beginning, that relationship between the advisor and the model provider.
I want to point to a couple things kind of on the tech side. I think one of the biggest barriers to adopting model portfolios, whether it's a custom one or an off-the-shelf one, is kind of how do you get your client's portfolio today to match that portfolio in a very tax-efficient way. Yeah. So I think 55IP, which is owned by JP Morgan, I think has been very innovative in that space. Then I think one of BlackRock's biggest advantages is kind of its Aladdin software. And I think being able to show clients what their portfolio looks like from different risk factors and show them how the customization options can change or not change that. I think that's the kind of confidence building tools you need for advisors to kind of buy in. So I think that's what everyone's working towards, is better portfolio analysis tools. And I think particularly as we get into more private investments, that's going to be even more important to see how, okay, I want to add 10% in this non-traded BDC. How does that affect kind of my risk profile when we know that the reported returns are very smooth and may not really reflect what's really going on under the water? So I think the portfolio analytics is where I would expect to see the most innovation going forward. I know, Morningstar's working on this stuff too, so I think I don't think it's like a secret by any means.
Great. So somebody is asking a question relating to fixed income. When replacing bond funds, how can advisors ensure they balance yield increase with maintaining an appropriate risk profile in fixed income investments?
Yeah, I mean, I think again, not to plug Morningstar, but using Morningstar tools to kind of help compare the before and after, and also individual bond funds, I think could be really helpful in kind of determining how the risk might change or how the duration might change as well in a portfolio. So kind of using those tools, I think could be really helpful for advisors.
Yeah, I think credit is kind of fluid across risk spectrums in the sense of maybe ironically, though, more conservative investors probably have more capacity for credit risk because they have less equity risk, so they can afford to have kind of a little bit more of that economic risk in the portfolio. But then when you get to like 60% or more equity, credit risk kind of just adds to volatility. So one thing you could do is think more about should some of this high yield be funded from a little bit of equity? the average equity beta of high-yield bonds over the last 20 or so years is about 0.4, which almost suggests that if you're going to allocate to high-yield bonds, you'd almost want like 60% to come from fixed income, 40% to come from equity. But as we get even more equity, or really young clients, you really kind of want more pure investment grade, almost treasury type exposure, because that really is the best diversifier over most periods for stock market volatility. And what you really want then is really just the kind of that balancing act.
Great. And are there any trends or sectors like large cap equity, small caps, or alternatives that are offering the most compelling investment opportunities for the next 12 to 18 months?
So we typically don't do market forecasts.
I didn't think so. It's not really what you do.
It's not what we do. There are other people at Morningstar who do it. I don't know their insights off the top of my head, but I think the most important thing when we're going through the uncertainty and volatility we're seeing today is, I think, one, be diversified and stay invested. I think there was a long period, probably from 2009 through the beginning of this year, where having international stocks really did not work in your favor. Mm-hmm. Basically, anything you did to allocate away from like the U.S. mega caps kind of hurt returns. Mm-hmm. But what we've seen this year is kind of a return to form for diversification, and I think that's what you want to always make sure you have a really diversified portfolio. So no matter what happens in the next 12 months, some of your portfolio should benefit from it.
I guess in a related question, can you identify any specific areas investors should explore further? Or is it, again, not your cup of tea? This is not where you provide the insights. That's fine.
I mean, I think just echoing what Jason said, like being diversified, within asset classes, being globally diversified. So, looking at your U.S. versus non-U.S. allocation, and making sure that you're diversified, within sectors, on the equity side and the fixed income side as well.
So really it's, don't get lost in the sauce. Remember the basics. Remember that you need to stay the course. You need to be diversified. You need to fit the risk profile that you need, as opposed to be trying to find the next new thing, right?
Yeah, and I think when we look at assets, so I'll give an answer, maybe something someone could think about. When we look at assets and mutual funds and ETFs and equities, it's about 75% U.S. and 25% non-U.S. Now, the global market cap is more like 65% U.S. and 35% international. So most people are probably significantly underweight international equities versus the global market cap. Mm-hmm. So not to say anyone needs to be global market cap, but international equities might be an area where maybe you are a little light, especially given the markets we've seen in the last 10 years.
Right. So this is our last question, and it's kind of stuff that we've already touched on a little bit. So if you can, expand on it more, that's great. So what steps can advisors take when customizing portfolios to prepare for potential economic slowdowns or a recession, especially within equity and fixed income? So is there anything, we've tapped into diversification, we've tapped into some other things. So
our colleague Amy Arnott actually has an article on this on Morningstar.com today about what asset classes do well in recessionary environments. And what it finds is generally U.S. Treasuries tend to be very reliable in recessions. U.S. value stocks kind of hit and miss, though I do think having like more stable businesses that aren't really super growthy and don't have high valuations should give you a little bit more of kind of a buffer in a recession. But I think like in general, what we've seen is treasuries work really well. High yield credit doesn't work as well because you have all the economic risk, and when there is a recession, that's when you're worried about can companies pay their bills. And I would just caution on private investments, which may look more appealing than they really are.
Great. Thank you so much. So if you enjoyed what our analysts had to say today, I recommend that you come and join us for our Morningstar Investment Conference on June 25th and 26th at the beautiful Navy Pier in the heart of Chicago. There you'll hear insights from more Morningstar analysts like Jason and Stephen, and I myself will be talking about how advisors can use behavioral science in their practice. Now, if you didn't like what our analysts had to say today, I still recommend that you come and join us for our Morningstar Investment Conference, and be sure to bring your hardest questions so you can try to stump them. Similarly, if you would like to hear more about customizing model portfolios, I recommend you download the report that Jason and Stephen wrote on the custom model portfolio landscape. That's all we have for you today, so thank you for joining us.
you.